A dollar today is actually worth more than a dollar tomorrow. And in this video, we're going to talk about why that's the case, but more importantly, we're also going to cover we can figure out exactly how much more it's worth today than it is tomorrow. So let's jump right into it. So this is the concept of the time value of money, right? We have to understand how time affects our currency or the dollar. Now, this concept or this principle of saying that money is worth more today than tomorrow really revolves around the risk involved with tomorrow. The example I like to use here is, maybe you're old enough to remember, or maybe you got grandparents who used to tell you this. You used to be able to go and buy a piece of candy for 5 cents or 25 cents. Right? But now when you try to get a Snickers bar, it's like you basically got to go out and get a private loan to afford some Hershey's and things of that nature. Now, this is caused by inflation, right? So inflation is essentially the power or the value of the dollar decreasing over time. So in order to purchase the same thing that you did in the past, you now need more of that currency. Now, inflation, we can't really predict and we can't control it. So we really don't know how inflation is going to change or impact the dollar in the next 5 years, 25 years. We have no clue. Or better yet, we can't do it accurately. We can guess, we can forecast, but we can't do it accurately. Now, inflation is the best example, but there's other risks. What if the opportunity isn't there in 5 years? What if we don't live to see tomorrow or 5 years from now? Right? Then the basic power of that dollar is gone. Whereas today, we can use it. We can actually go out and purchase something with it when it's a dollar in our hands. So the real question is, well, how do we determine what we can pay today for something in the future or vice versa? So this is where the concept of compounding and discounting come into play. There's this beautiful thing where we can take a dollar, it can earn interest, it can grow, and then that dollar is now worth more. All right, so let's just use 10% as an example. $1 earns 10%. Then next year, you have $1.10. Well, now it's $1.10. That's going to grow at 10%. And next year, you have $1.21. Right? And so this compounding effect will continue over and over and over again. So the principal amount that's earning interest continues to grow and then continues to earn interest. So compounding is a function of starting today and then forecasting what will it be worth in the future. Discounting is the opposite. Discounting is saying, hey, look, I see something that's worth $100 in the future. How much should I pay today? Now, the growth factor for both of these things, right, the compounding and the discounting, all depends on interest. So we want to know what the interest rate that it's compounding at. And so in our example, we use 10%. But we also need to know what the discount rate is. How much are we going to discount backward? If we use that same dollar concept, hey, I got $1 today, it grows by 10%, $1.10 the next year, and then $1.21 in year 3. Well, if we started with year 3 and we said, hey, I need to have $1.21 in year 3, my discount rate is 10%. So what would I be willing to pay today for it? Then we would back it up and we would come up with that same dollar. We'd be willing to pay $1 today, growing at 10%. For 3 years, boom, that's our discount rate. Now let's talk about why this is important, especially for real estate investors. When we get our financial statements, our trailing 12 months, our profit and loss statements, when we're going out to look to buy a property or purchase a business, we get to forecast out the cash flows. We get to know, hey, I think this is going to cash flow this much in year 1, 2, 3, 4, 5, and so on. And then we also get to calculate what we might be able to sell it for. So we see all the future cash flows. We see them. But the question becomes, what should we pay today for all of those future cash flows, right? A lot of times we look at something like internal rate of return. We got a couple of videos on IRR. We could talk about that later. But really, we should be looking at what's the net present value. It's discounting all those future cash flows to understand what I need to pay today. Now, when we're choosing a discount rate, right? Well, how do we know how to bring it back? Well, this all depends on you, the investor. It all depends on what you want to earn. Now, people have different discount rates for different reasons. Some people are like, hey, I just need a safe place to park my money that's earning a little bit more than the bank. So I'll be good with the 6% discount rate, right? Some others are saying, no. This is a bigger risk. I want a bigger reward. I need 15, 16, 17% of a discount rate. Whatever the discount rate is, we now get to take that number that percentage, and discount all those future cash flows and the future sales proceeds to determine what should we pay today if we want all of those cash flows to equal 6% or 15% return on our investment. That's the power of really understanding the time value of money. Now, I use this myself when I invest. We've done this with other clients as well. When they come in and they say, hey, look, we need to get a 15% return on this. We need to get a 7% return on this. Great. Let's look at the financials. Let's forecast it out. And then let's determine what you need to pay today. Once we understand what we need to pay today, that's where the negotiation starts, right? So if you need to pay, let's just say $500,000 in order to get, whatever your discount rate or your desired yield is, then all we have to do is say, all right, let's start our negotiations at $420,000. 430,000, and let's work our way up, because if we can basically get it for 500,000 or less, then we are going to be able to achieve our yield. Now, obviously, guys, forecasting is it's a science, but it's not an exact science, right? So the better you are at forecasting, the better you are at being able to determine what the proper present value is or what the proper purchase price should be. Now, as I mentioned, we do this all the time, not only for ourselves, but for other clients. And we also help clients understand, as you're doing your portfolio management, right? You've got maybe a couple properties, maybe a couple of assets, maybe a business. Well, what should we sell it for? How should we position it? So if you're a real estate investor or a business owner and you're looking for an accounting firm who can help you with this type of analysis, then go ahead and see the link below, schedule a call, and we'll take it from there. As always, thanks for watching, and we'll see you in the next video.